Okay, we've now got recording on. So we'll now start. It's just 10 o'clock. Welcome to our fourth seminar, which is coming from, well, I'm in the UK, and in Dorking, the photograph is of Watton House, where we hold our seminars, and Mark is in Chiang Mai. Had a few technical problems initially, but we seem to have sorted those now, so hopefully it all goes smoothly. Never had these problems on the beach in the Philippines, but I guess when you're back in the UK, who knows what might happen. We have an interesting program for you today, and the first session is Mark's. I'll get out of the screen, which I think I can now. Okay, so the first thing is Mark Austin, a binary overview. So Mark, I'll make you the presenter so you can take it away.
Okay, fantastic. Thanks, John. Well, firstly, good morning to you. I mean, it's afternoon here in Thailand. We had a few hiccups with the technical sides then, but as I said, hopefully that's all resolved now, and we can press ahead. So firstly, what is a binary? Well, a binary is a bet, and it's in the form of a fixed odd bet, but it's actually expressed in a different format. So the key features of a binary are: the bet is a winner if it's priced at 100, and it is a loser if it's priced at 0. So the prices fluctuate between 0 and 100 at any given time. So, but it is the bet description that determines whether or not the binary will lose or it will win. Okay, so binaries are linked to a predetermined expiry, which is time and date, and this is very relevant for the actual outcome. So that they can fluctuate between 5 minutes up to a year. 5 minutes, I don't see much sort of edge in the market for them, but certainly if you want to go for 7 days up to a year, you can use bets on markets, and for lower time scales, you can use IG, and as I said, they range from about 5 minutes up to daily trades. So between the expiry, the price will vary between 0 and 100, and then obviously at expiry, it will either go to 0 or 100. So what are the benefits of binaries? Well, first of all, your risk is free, which really is a bonus for those who are new to trading and maybe don't have or haven't learned the control and discipline that they need for trading, because we've all been there where we've had a stop and we've let a trade run on, hoping that it will come back to scratch or back in profit. But of course, these trades rarely do, and they can result in your account being wiped out. So at least if you're new to binaries, new to trading, binaries can lessen the impact of this. The profit potential is vast. I mean, for those who don't know, binaries can go up to 9,900% return. I mean that's just fantastic, and it's very hard to get that in other sort of trading vehicles. You can profit from big moves, from small moves. So for example, if the FTSE, to finish up for the day binary, if the FTSE was, say, down 10 points at, say, 4:20 in the afternoon, and you had some good analysis and a spike up to finish up for the day, you could buy between, say, 20 or 30, and if it came true, you would win 70 points, whereas the move on the FTSE would have been only 10 or 12 points. You can get the market completely wrong and still make money. They are through tunnels, and they are range-bound bets. You can risk as little as 1 point to make 99 points. Certainly, very, very, very difficult to do that with a spread bet, because your stop loss would most likely get taken out easily. You can forget all about stops, which is really a big relief, because if you're not concentrating on stops or what you're about to lose, you can concentrate on running your winners. Now, a key thing, that is a key skill in trading, and a lot of people focus a lot of their time in entering a trade, whereas actually the skills for becoming a profitable trader is when to actually exit a trade. Or if you're not focusing on stops, then you can really concentrate on sort of running these winners long term. Risk is all managed for you, as we've talked about the risk. You can't lose more than what you stake on a binary. It's all automated. Another key point is they're tradable, just like a spread bet or any other form sort of instrument that you're using, and you can take half profit. So if you bought the FTSE to finish up, for example, at 10, you could take profits at 50 or even 60, or take half profits, and the trade is then risk-free. And sort of going back onto the risk side again, I mean, you have to ask yourself the question: how many spread bets have you let run past your stop, hoping they're going to return back to profit? And I think it's more on a psychological level, this as well, because a lot of people don't know this, but if you take lots of small losses, it actually strengthens your trader's mind, and it will help you profit in the long term. Now, taking small losses is all about trading. You have to do that to make the profits. But we want to avoid taking the big losses, because if you do suffer a big loss, it can really hinder your trading going forward. And psychologically, it can always come and hinder you in future trades. Another big benefit with binaries is you can catch falling knives. So if the market's falling, like for example the recent crash, which I'm going to go over a trade review later on in the webinar, but you can buy extremes when the market's very oversold, or you can sell extremes as well when the market's very overbought with a binary, in the sort of comfort knowing that you're not going to get stopped out. So if the market, say, fell another 50 points, that's not going to worry you if it rebounded straight away. But obviously with a stop, that's something you have to consider. So with binaries, you don't have to get the timing quite so right. So how do you trade binaries? Well, FTSE to finish up is a price of 20, for example. So the risk of this trade is 20, and the reward is 100. So you can work that out by the reward. 100 minus 20 equals 80, and this gives you a risk-reward ratio of 1 to 4, which is 400% return, which is very, very good in trading. I mean, in trading, if you're getting around 2.5, that's good, but if you can get it up to 4, that really is good. Now, the implications for this are that if you are using a system of a, say, 50-50 hit rate, which is quite easy to discover or test out, if you've got a risk reward of 1 to 4, then obviously your losses are always going to be on the 1 factor, but obviously your rewards are always back up to the 4 factor. So this can be really, really, really beneficial in binaries. And then obviously if you get the system up to a 70% hit rate, that's even better, because then you can start buying binaries at 30 or even higher, or selling them at 70 or even slightly lower. The probability of a binary, well, the price may reflect the probability, but it will not be the probability. So what I mean by that is that the binary is linked to price, volatility, and time. But where we get an edge in binaries, and this is if you're testing systems, you want to be looking at things like the news or technical analysis or any other sort of price systems that you have, because the binaries do not take account of this in their pricing, and this is where you get your edge. So the types of binaries you get the up-down binaries, which is just the FTSE to finish up or down for the day. 1 touches if the FTSE touches a certain level, and no touches obviously if it doesn't touch a level. Tunnels, these are range-bound bets, and the high or low of the day, or for a specific expiry date, if it reaches a certain high or low for that key period. And then there's hourlies and frenzies, which I don't even look at. Personally, I don't see you can get much of an edge on hourlies and frenzies, and it's more of a gamble. So the price the price, as we've just sort of talked about, is linked to time, the market price, and volatility. And in terms of prices, you'll find that they move very, very slowly when they're at 20 or below. 20 to 35, they start to accelerate. 35 to 65, you're going to get a lot of volatility between that. 65 to 80, they start to slow down again, and 80, they get very slow. So really, when you're entering, if you want to get a good risk reward, you want to be buying at stable prices and at good risk reward, so 1 to 4. So you want to be looking at buying at 20 or below, or selling at 80 or higher. So when do you use binaries again? Well, just say your analysis is calling for a big move to the downside, and you really want to leverage up and get some good reward out of this, but you don't want to go over your 2% that you risk on any given trade for your account. Well, excuse me, with the binary, you can gear up and leverage up for this. You can't do that with a spread bet without really narrowing in your stop. So the binaries can really work in this situation. Volatility, we've already talked about this. When the market is yo-yoing up and down, and there's extreme highs and lows, the binaries can really suit you in this in these sort of market conditions. Whereas a spread bet isn't going to really help you unless you're using a very wide stop. But then you've got to consider your risk, because your risk will be very high then as well. And then lastly, you can use binaries to hedge. So if you've got a good trade, you're in a good trade and you want to run it, say you're on the long side, but your analysis is calling for a bit of a fall or a decline, medium term, you might want to hedge. You might want to buy a binary which gives you some exposure on the downside, and this will really help you run your winning trades at the same time. So you can profit both ways. So that's the main advantages of binaries. And as I said, later on in the webinar, I'm going to talk about a trade setup, which I did for the service recently.
Next session, which is basically looking at a few questions which have been sent. I think, Mark, we'll both actually, I think these questions perhaps deserve to be answered by us both. Could you possibly give a more detailed subjective judgment? I'm not sure whether actually he means objective, because subjective is slightly different. Of course, this is a subjective thing. Subjective judgment on the chances of success of the various trades which you and Mark enter. At the moment, you do this by advising a normal trade on some trades, maybe different percentages for other trades. I mean, normally 50% trade, for example. Now, this isn't always a question of success. In fact, this is often a question of risk. If we have a bigger stop, for example, then we might well suggest a 50% position. I mean, for big call service, we base our recommendation on £10 a point, and if we go for 50%, that's £5 a point. So if we've got a stop, say at 30 points, which is unusual actually, we normally have bigger stops than that, but that would be 30 points at £300, sorry, 30 points at £10 a point is £300. Obviously, if it was 60 point stop, then it'd be £600. So we have relation that the actual variance, i.e. the percentage, doesn't necessarily affect or doesn't. It's not a statement on the success possibilities of the trade. It may simply be a risk situation. But there is also questions where there is also a situation where the trade may seem a little bit higher risk for some reason, and that is a subjective judgment. It can't be totally objective, because that's not the way markets work. Markets are not a mechanical machine like an engine of some sort. They're more of an art form to an extent. There is no certainty in what we're doing. So it's really quite difficult to give I mean, every trade Mark and I enter, Mark, I'll ask you perhaps to make a few comments in a minute. We feel the chance of success outweighs the risk, and this is the key point. We want an edge. We want to. I mean, a binary is a nice way of illustrating this, because with a binary, in fact, Mark mentioned this, the probability of a binary is reflected in the price. It's when we feel, or the trader feels, that the probability is different from the actual price, that an edge becomes available. So if you buy a binary at 50, meaning when you got 2-to-1 bet, it's 50% chance, but you feel there's a 3/4 or 70% chance of success, then you've got an edge. And I mean, so it works both ways. You might feel that the binary is only 20% chance, so it's very unlikely to come true, in which case you can sell the binary and hope it goes down to 0. So it's not so simple a question. I would just add, I mean, my viewpoint these days is longer term. I think as one gets older, one tends to have to adopt a longer term approach and get away perhaps from shorter term action in the marketplace. And Mark's is shorter term. Do you have any add on that, Mark?
Well, I mean, I do. I mean, certainly there's some key points here in any fact. Anyway, I mean, certainly I wouldn't recommend to do a trade if I only thought I had a 30% chance of succeeding anyway. All the trades I issue for the service, I'm confident on. Otherwise, I wouldn't be issuing a trade alert anyway. Now, if I do say 50%. Usual trade, it's usually down to either I'm using a higher stop, so I'm aligning my risk with my with the reward, or I'm using a very narrow stop, and I feel that we don't need to be risking so much on this trade because the stop is so close anyway. So it's not really about the chances of success, because I wouldn't be issuing a trade alert if I didn't think it would succeed. Obviously, in a trade, we're never quite sure, but there's never any trades that I'm 100% sure of. Likewise, either, because in trading, nothing is 100%. So as I said, the 50% on normal trade statement that I make isn't really that connected to the chance of the trade succeeding. It's more down to balancing risk.
Okay, well, I think it probably covers that. As I say, you can ask questions. We have actually got a question from Robin. I think it's from you, Mark. He says, very new, I think meaning himself, can you say more about hedging and also Mark's view of going both ways? What do you mean by going both ways? But I guess it pretty means tunnels.
Well, I mean, very, very quickly, the tunnels is a range-bound market, a range-bound instrument, which means that it would be betting that the FTSE will stay within, say, a 50-point range for the day, or outside a 50-point range. It doesn't really matter if the market rises or goes down. It's just whether or not it goes out that range. So what was the first part? So hedging. And in terms of hedging, well, hedging is simply that if you're long, you would also take a position to cover you on the short side. So you're covered both long and short.
Okay, next question is to me from Michael. Surely the older you are, the more short-term you should be. We don't live forever. Interesting point. I mean, I think it rather depends on a number of factors. I mean, one, of course, is wealth creation. You know, I mean, as people acquire wealth, they tend to get more risk averse, and also they don't have the sort of burning desire to have that put in a lot of effort. So I think those sort of people would shy away from short-term trading. Plus, I think one relaxes a bit. You know, one gets a little less manic, if you like, a little less driven. Me certainly, I think I feel that way. Which also, of course, drives you away from the shorter-term action, I would say. But I guess if you're looking at that, you've got a lot you want to achieve that you haven't achieved as you get older, then I guess you might get even more driven, which perhaps is what Michael's referring to. And please ask me another question. Quite an interesting point. I hadn't thought about it in those terms. Right, next question. This is from Trevor. Just to be sure, I buy a binary when I think the parameters will be met, but I think the range will be greater than, say, 60-60, I sell. Yes, that's correct. But basically, you sell a tunnel when you think. In fact, it's basically look at the bet description. The key thing is the bet description. If the bet description is that the FTSE will stay in the range, and you think it will stay in the range, you can buy the bet, as long as the price is attractive. You can still buy when it's unattractive, but that may not make a huge amount of sense. If you think that the bet description will fail, so that FTSE will not stay in the range, then you'll sell the bet, because the nature of the binary is that if the same is true, it'll expire at 100. If it's false, it'll expire at 0. So that's a key point. And you've got to look at the bet description, because the tunnel bet, for example, on IG, is to stay in the range. But some tunnels are quoted. I think Bet on Markets does this. Is actually to go outside the range. And so it's very, very important you read the bet very carefully. If you read the bet description carefully, then you can't go far wrong, although some bets are a little bit confusing, but that's another issue. But most bets like tunnels are pretty straightforward, really. So I hope that's helpful. You're not putting the questions up on screen. No, I can't afford. It doesn't seem to be a facility doing that, Ken, so I wish I could, but it doesn't seem to be possible. Binary, before you start a tunnel, what is the power of parity? Mark, do you want to take that, or shall I take it?
Oh, you can take that one.
Parity is important because with a tunnel, when the market's at parity, and parity means unchanged on the day. So if FTSE closed at 6,000 yesterday, then if it's trading at 6,000 a day, then there's zero change. It doesn't need to be exact. I think plus or minus 10 points. It depends on the market, what's happening, but and really depends on the tunnel price, in fact. But the key thing with parity is that when the market is unchanged on the day, and you're looking, say, at a 60-60 tunnel, it's got to move 60 points in either direction to break the tunnel. So that's the maximum it can be. If it's up 20 points, then it's got to move down 80, but up 40, for example. So if it moves down, then you're still 60 points away. So the price is liable to be lower as the tunnel nears the extremes, i.e. plus 60, minus 60 in this example. So the power of parity is a two-way thing. Firstly, near parity or at parity, the tunnel price is higher, so we're going to sell it. We get a better price. But the other point is that if we're away from parity, then any move that we're expecting, we're not sure which way it might go, might simply take the market back to parity. So that's not great. I mean, you have to pay more, plus a move comes in, just goes back to parity. It's not so good. So I hope that helps. I'm just going through the question. Unfortunately, it's a very, very small question box. I'm not quite sure why that's the case, but it's quite difficult saying it. So I've done the parity. Range question. Is staying in the range less risky than expecting a tunnel to go out of the range, or does this generalization simply not apply? And that's from Robin. It doesn't apply in the sense that it depends on the width of the tunnel. So, I mean, a very wide tunnel, and you should check this statistically. You can go back, say, 2 or 3 months, look at a chart. You can find them on Yahoo Finance or ADVFN, and just take down the ranges. Or in fact, you can probably download data and do it on Excel. And you can see the average range of FTSE. That'll give you an idea whether the odds of any one particular tunnel being broken or not is higher or lower. I mean, in fact, the binary price will reflect that to an extent. So if you look at the opening prices on the tunnels on IG, or we're loaded on the IG now, and the prices reflect the odds of that tunnel being broken. So if you take say the 100 tunnel, it's often in the high 80s or 90s, meaning that there's a 80%, 90% chance, statistically, that tunnel will stay in the range. But of course, and that changes with volatility. In very volatile markets, as prices come down. So it's not really possible to you can't really generalize, but you could certainly do the analysis and work out what the odds are on any one particular tunnel. And the research is important. You're putting in the work is what gives you the experience. What gives you experience gives you clarity of vision eventually, and that leads to profits. And doing that kind of research is critical. It's a step. It's something that I intend to plug away on at the POM seminar next weekend, because it's what it's all about, really. And we have people, if you like, our students who are now becoming experts themselves, talking at the seminar because they've done that. They've become. It's not with this sort of research. It doesn't take long, and you know something nobody else knows at that point, which is always valuable. Knowledge is power. I've got another question here from Paul. Also, as it deviates away from parity, it accelerates more quickly either way, therefore more profit. Well, that's not necessarily true. I'm not quite sure what you mean there, Paul. Perhaps you'd like to expand on that question. Are there periods each year when volatility is higher than other times? Well, certainly are. The problem is it's difficult to predict when they might be. This is always a problem with markets. You never know exactly what's going to happen next. You do know certainly that there are cycles, and you know that after a very quiet period, at some point you get a much more active period. So we take the VIX, for example, which is well worth.
Just add on that, John. I mean, in terms of periods of volatility, I mean, we know that around Christmas time, and we know around July, August time, well, particularly August time, there's less volatility in the markets because it's holiday time, traders are away, and usually for me I find volatility is more pronounced at the beginning of the year. So we're in this sort of period now when volatilities are higher, and I find as the year progresses it can taper off. But as I said, it depends on the cycle and what's actually happening within the markets at that stage.
That's very true, yes. I mean, August is actually an interesting period because often it's a holiday period. For some reason, often you get very sharp moves in August. I mean, the 87 crash started with a peak in August, as happened, and it's although there are periods when you expect things to be quieter, it doesn't always work out that way. But yeah, certainly it's worth looking at those sort of seasonals. I think so I hope that's helpful. Robin, there was a big swing over 100 points on the 1st of April. I could see it coming, but did not back it. Seemed too risky. What was your view of that event, 1st of April? Do you have any view on that, Mark?
1st of April, God.
I'm sorry. So it's difficult. To have, we haven't. I'll try and look at that when I look at the charts in a short while. But it's markets. There's so much data coming all the time that it's really difficult to remember something that happened unless we get pre-warning. Really, that's the kind of question that could have.
I think I know the one he's on about, but I'd have to look at the charts again to sort of analyse what happened during that trade to give a firm answer.
Okay. Right. Tony, I think our binary is only available on IG. No, they're not. But the tunnels currently, they're the only site I'm aware of in the UK that offers tunnels. I mean. Bet on Markets does, but the minimum distance is 3 days, I think. There are no other sites, Mark, are there at the moment?
Sorry, what did you say, John?
The question is, are binaries only available on IG? I'm not sure there are any other sites in the UK now. Are they doing binaries?
Well, no, I mean, it's Bet on Markets and it's IG that offer the binaries at the moment. I don't know of any others that offer binaries at this stage.
There are various sort of rather dubious sites, I think in Cyprus and places, which only offer up-down bets and give you the most appalling price. So you pay, I think, 70 for an up-down bet, which should be 50 or something. But I mean, the odds seem to be really highly against you, so I wouldn't really recommend those particular.
Just stick to Bet on Markets and IG. They offer a good range and they're well known and they're regulated, so stick with them.
I'm trying. So there are quite a few questions there, which are difficulty. Okay, they're all gone now, I think. Okay, so we'll move on to the next question. Again, I think Mark, this is one we both perhaps answer. To what extent do you think IG and other market makers in the spread betting field are influenced by bettors who put their stops online, i.e. move the market towards that stop? Isn't it better to set an alert than dive out manually? I don't think IG would hunt stops. That's my view. I could be wrong, but certainly I don't think that it would be in their interest to do so, really. I mean, it might be in their short-term interest, but people like IG look at the longer term, and the longer term is where it's important. And a bit of short-term interest can destroy your business. So it's just dumb, really. IG aren't dumb, in my view. But if you put a stop in the marketplace, the market is there. The purpose of the market is to maximize trade. Everybody in the market who actually works in the market gets more cash the more trade that goes through. And you'll see all these marketing stuff going out from various places trying to get more business, new products with a view of getting more business. And if you put your stock in the market, you're announcing to the world, I'm prepared to trade at that level. And you've got this big machine that wants to trade as well. And you're sort of saying, look, come on, let's do a trade, shall we? So I think it's a good point. I don't think IG. I mean, I'm talking about the other market makers. There's always a few people who don't have the highest standards. I think IG do. But again, this is my opinion and my experience. Of course, I've been trading with IG for 20 odd years now, and I've never ever had a problem with them. That I have with Merrill Lynch. Even that's beside the point. But IG, over all that period, I've never had a single situation where I would say that. I mean, certainly some of the prices I disagree with, but that's different. There are reasons why, and if a whole lot of business goes on to a bet, then they will move the price. But then that's the nature of the market. The same with any futures contract, any contract. Business trade starts bumping onto a price, then that price will change, and that's how the markets work. So that's my view. I think, Mark, you have a slightly different view, so maybe you'd like to say what you think.
No, I mean, as you said, if you place a stop in the market, you are, to a certain degree, inviting the market to take it. But I think it's also, I think you've got to gain some sort of reality on this as well, that it's very easy to feel like you've been singled out, and you know, the spread betting company has gone out and hunted down your stock personally. But I mean, really, that's not going to be the case. I mean, there are institutions betting huge amounts into these sort of these companies, and you know, for an individual trader, you know, the amount we're placing with these spread betting companies is minimal to them, really. It's the institutional trades which, you know, if they were looking to hunt stops, they want to be aiming for them. And if you are worried, then you know, if you are trading the stops and you're looking at your screen, then you know, think about using a psychological stop. So you're monitoring it. If you see acceptance, you see that the market has taken out that level and it's continuing, you can then close your stop. But I mean, obviously, a lot of people have to use stops because they're working, they're not looking at the screens all day, and you know, they have to get on with things. But certainly for longer term moves, for me personally, I use acceptance, so that if I see prices take out a specific level, then I'll close it manually. But obviously, if there's a price spike, then I'm still in the trade. But for very, very short-term day trades, you have to use stops. We're using very tight risk parameters. The action is very quick. The targets are very quick. So on the very short-term basis, I would recommend, you know, using stops and not focusing too much on using mental stops.
Yes, I just find, I mean, certainly the mental shop approach is a better one, really. But of course, it's not always appropriate. You've got other things to do. You maybe have a meeting or something, or whatever it might be. And you know, if you take, I mean, for example, there's a guy, Colin Yeager used to work with, a chap who had a very good system called Yeager Waves. And he went out to buy a newspaper, which would take him 5 minutes, and got to a level crossing. The car approaching him stopped, but there's a car speeding behind that car, crashed into the back of the car that had stopped, and knocked it into him, and he ended up in hospital. He was out of action for I think 2 days, and he lost quite a lot of money because he had no stop in the market. So you know, it's quite important really to understand the risks. I mean, okay, you don't normally have a problem crossing a zebra crossing, but you know, do you want to take that chance when you've got a position in the market? So I think that's probably enough about that one. Hi John, Marcus and Jeremy. Can you suggest a good charting package that's easy to use and good value? I use Morningstar, which I think is great, but it's about £100 a month. I think Update is good as well. You don't get futures with that, which are quite useful. Mark, any comments?
Yeah, I mean, Update is certainly one of the better ones out there. So if you're looking to sort of get serious, then Update is probably the one. I think there's other ones like eSignal, but
yes,
as far as I'm aware, Update is number one at the moment.
Okay, next question. Have you any experience with pro spreads? You say they are for the professional trader. I haven't used pro spreads. Have you, Mark?
No, never heard of them. Sorry.
Okay, sorry. Okay, next question. Do you scale in? For instance, on Friday, your text was for 65, tunnel 87. Was 80.7 when I checked, but it then moved to 83, so I entered. Then went to 88 fairly quickly. Is it wise to scale in with a second bet, or should one take it as soon the market is going? That's really up to you, I think. I mean, you can argue it both ways. It's a matter of trading style. If you're happy with the price,
it's a technique you can use, certainly. It's a technique you can use, certainly. There's no problem with that. So yeah, I mean, if the market goes your way, then you know, it's going to be more difficult to sort of leverage back up again. But certainly, if it goes against you, you might want to commit some more funds into it. But I don't personally use that trading style. But you know, each to their own.
Okay, Robin's asked, I thought stops are automatically added in some situations, e.g. short spreads. With Gecko they are, in fact, but you don't have to accept them. You know, if you feel the stop they've placed is not the one you want, then you just simply change them. I would really suggest you do that, because you know, the risk parameters that the betting site may suggest to you are not anywhere. I mean, there's no reason why they should match what you want to do. So although some betting sites, and Gecko in particular, do enter stops automatically, I don't think IG do, as far as I'm aware. They might do with a limited risk account, but I'm not sure that's the case. And it probably is, in fact. It's probably quite a wide stop. You know, so they'll use their own parameters, whereas you know, if you're going to trade, you've got to use your parameters, which you've thought through and which you've worked out work for you. Any points, Mark?
Yeah, I mean the spread betting companies, they calculate it on a risk basis. So I don't know what the actual percentage is, but they do this. They do the stop on a calculation of say 5% of your account. But really, I mean, I strongly urge that you place and sort of work out your own stops and don't rely on spread betting companies to choose your stops, because they may not be in line with your own risk parameters.
Okay, next question says continue. I think this is actually a continuation of a previous question from Chris. Is going against us and better to close the first position? I think this is all about edging, going in stages. Again, it depends what's going on. It depends on your strategy. It depends on what you're trying to achieve. It depends on a whole load of situations. Really. I mean, and also there's no better or worse. It's what you've tested and what you've found to work for you, and what works. Your strategy that works for you. So it's not about. Unfortunately, the markets. It's unusual to find something that actually is better. I mean, even using stops in a sense. I mean, I find with like ETFs, I don't use a stop. And I may suffer for a while, but then that's built into the original purchase. So I don't, I'm relaxed about that, and then it will come good eventually. You even have to wait a year or two for it. But on the other hand, if you're short-term trading, you can't really afford a 200-point loss if you've got a big position, for example. So it's, it depends on what you're trying to achieve, but there are a few free lunches in the markets, as far as I can see, Mark.
And also, I mean, the proper style of trading, if you want to do textbook trading, then you shouldn't really be adding to a losing position. I mean, ideally, if the trade's going the way you want it to, you should then consider adding to the position. But if it's going against you, you shouldn't really be adding to a losing position anyway.
Unless it's your strategy, I think it's appropriate. Actually, it can be appropriate to do that if you want to take a position of a certain size, and your first trade just to get on board, and then it goes against you, so you have a better price. I think that's fair if it's your initial strategy, not so much if it's something you do emotionally. Okay, on the hoof, as have never thought about it, but is there a binary which would bear resemblance to a limit entry order? E.g. yesterday with the political situation in the US, I just wanted to leave something on the short side, so left a short limit order on FTSE, sort of based on Mark's analysis, which got filled, and either I could left to provide some protection on my small ISA over the weekend, or if it happens, after hours the US market came back fast, so I took a small profit in the evening on the FTSE short. Could I run the same with a binary? Make any sense? If not, just ignore. A bit late now. Anyway, that's fine. I mean,
I think he's asking whether or not there's limits or targets for binaries. There used to be with is it FinSpreads, John? I think it was. They used to
yes.
They used to provide limit orders, but then they got rid of that. And unfortunately, IG and better markets don't offer that either. Maybe one day, but certainly at the moment they don't give the luxury of the limit orders, unfortunately.
Actually, I think the question was actually a different one for that. I think what he was asking was whether you can actually adopt a binary, like FTSE to be down, FTSE to be up, which wouldn't get stopped out. In fact, it's what you do quite all the time, Mark. I think it's something that you use as a technique. You look at the spread bet, and you look at the risk parameters, and then you say, well, if I bought FTSE to be down for, say, 20, I'm only risking 20, and I can't get stopped out. So I think that was the point of the question. I know it's difficult because I'm reading it out, and it's quite a long question. But that's what you do, isn't it?
Yeah.
So the answer is yes. Yes, certainly. The binaries can do that kind of stuff.
I think I'm going to have to actually read that question, actually. But certainly email me on that one, and I'll have a look at it and have a think about what's actually being asked.
I think I may have deleted it now, actually. Unfortunately, I can't see the other question until I've... But no, I mean, certainly you're asking really whether you can put a position on that's less risky than a spread bet, and I say yes, you can with a binary, because you can buy, say, you can buy FTSE to be down in this case, you want to go short. But the problem is, because when this FTSE is down, you're going to lose money because the binary is either yes or no. So if the market goes down 30 points, your spread bet will make 30 points. But if the FTSE ends up 2 points, you're still going to lose money on the binary. So it's different. There is advantages, but it's again, there are no free lunches. Okay, let's get rid of that one. I hope that answers that question. But please do ask again if we don't.
Yeah, just email me personally if you want sort of more clarity on that.
With both of you being experienced traders, do you trade currency pairs on news releases, or do you think this is too risky? I never have. I don't think, Mark, have you traded currency pairs?
I mean, I touched on currencies in my early trading years, and I just didn't get on with it. That's not to say that many people do. I mean, there's many people that profit from currencies, but for me, I never really got on with currencies. I lost a fair bit on sterling dollar at one point, and yeah, I just decided to sort of keep my skills on the FTSE. But yeah, I mean that's just personal. I mean, a lot of people probably do make a lot of money out of currency pairs.
Yeah, again, it's about discovering your trading personality. Unfortunately, we haven't got the experience to answer your question, I'm afraid. Which is, I mean, I think you find all traders, pick their own focus. I think, well, I mean, I've traded a lot of things in my trading career because I've been around for a long time, but not currency pairs, unfortunately. Anyway, we must move on. Last of these questions. At the moment, the FTSE in Wall Street is trending, and I can't see any opportunities this week. Have I misread opportunities? When I cannot see a predictable sell, it is by definition then a predictable buy. It doesn't really work that way, unfortunately. At the moment, we've got a market which is not going, not bouncing down enough to actually see a complete correction and leaping up again, and we're not really seeing. The market doesn't fit in with my parameters, really. I guess what it comes down to, which makes it difficult for me to see opportunities. I mean, obviously there are opportunities, and people who look at different techniques will be seeing stuff. So, I mean, Mark's been trading more active. Well, of course, with the big call, we don't trade that actively. We look for big setups, and they're quite hard to find right now. I'm looking at it in a minute, in fact. Mark, any comment on this?
I mean, certainly this week it was a tough week in terms of opportunities because, as I said, the market was moving in a 50-point range, and most of those moves were happening out of hours anyway. So not the best week. There were some opportunities there. I mean, we had a couple of trades during the week, but when the markets are trending very slowly, they're overbought. It's very hard to get very short-term opportunities. But obviously, the guys who are taking the higher risk and are doing trending trades, longer-term trades, they're benefiting from the market slowly creeping up. But I mean, on the high end side, the week before that and the week before that as well, there were lots of opportunities in the FTSE. So it's not always going to come. It's not always going to be perfect market conditions. You sort of have to be patient and wait for the market to deliver the easier opportunities.
Thank you, Mark. Okay, we're going to go on to markets today, which I'll keep fairly brief. So I'll be doing my video clip tomorrow, in any case, as usual. So I'll just look at the Dow and FTSE, in fact. I think this is a fairly ominous pattern here on the Dow. I did show this chart, I think, in the technical trade during the week. We've got this big impulsive decline, so I can't do an arrow thing, but so we've got this big move down, and now we've got this, what looks like an ABC. I mean, that's the way 1, 2, and then this thing here is we're still in that trend channel, and we're just bouncing around on the lower trend line, and it's quite a steep channel. I think the Dow has broken down this low here. A nice spike low. It was a buy signal, obviously, and the market has bounced back, but it's still right in that. So I'll just go down another the daily chart, and let's get my drawing tool back. I'll use the highlight. That'll be easier. Again, we've got 1, 2, 3, 4, 5. Now we've made new highs now, so quite what we're seeing here is not too clear. But that's an A, B, C. If we look at the trend lines, we get this different picture where we've got the Dow here, just not breaking away. In fact, closing right on it again on Friday, and it's having trouble getting above that line. Not unsurprisingly, given the rally we've seen, and also, of course, the 5 waves. These are fairly important things. It's possible the count here. Actually, I could change this count. Let me just erase this this drawing tool. I need to erase the whole chart now. Which is too good. So one possible alteration of the chart. In fact, this is 1, 2. Then we've got a 1, 2, 3, 4, 5, and we've just seen either a complete ABC, or we're now going to see a 4 wave, which might retest this key support here before one final 5th wave. I mean, there is this June peak that people are talking about because the QE is due to end. It doesn't mean, of course, it won't be reintroduced or another leg of QE coming in, but I mean, certainly the evidence I see, the people I talk to, that there is no real recovery in the economy. So, I don't. The only reason share prices are going up is because all this money's got to go somewhere, and where else do you put it with interest rates being so low? And I'm not sure that's not a very healthy thing from the point of view of the markets. Mark, any comments on that?
I mean, it's the Dow Jones, and as I said, it could quite easily collapse from here, quite easily. So there's so much bad news out there, but again, we have to really, look at what the price action is doing and try not to predict too much. We want to trade what we see and not what we think is the golden rule here.
Joe Ross said that first. I think she should have actually said not what you think and feel, because a lot of emotions come in. It's not just thinking, it's actually emotions as well. But I think it's a pretty good statement, and he gets credit for making it first. Well, unless, of course, he got off somebody else. We never know about these things. Right, this is a chart of FTSE with its big triangle since the peak just on New Year's Eve 1999, so it's 11 years now. And that's the wave A and B and C and D. So I got that wrong, haven't I? It's because we've got this one last rally coming up here. So in fact, sorry, the first move down is actually wave 1. Then we've got 1, 2, 3, 4, 5. This move does look like an ABC at the moment. It does look like I've got an A and a B, and then possibly a C up to the 660 level, which could then, see a major fall with I think a peak this year. I'm still looking for a peak this year, followed by more serious action in 2012 when there should be some, I think, much bigger profits available from the markets. That's really all I want to say about markets. Dare I say there'll be a video tipping out tomorrow, which I'll probably send out of my entire list. So anybody on this seminar should get that. If you don't get it, then just email me and I'll happily send it through to you. I'll just come out of here. Just find a way of doing that. Okay. We probably had enough questions. Actually, no, just look at the questions we had from that session. Okay, Chris, as a general rule for FTSE and Dow, what portion of your trades are binary compared to spread bets? Well, I guess obviously different for both. I suppose I probably trade up futures. Well, I know it's futures because that's what they were called before the spread bets came along. Probably about 50-50%, but I trade ETFs as well now. I mean, a lot of my bigger trades are made by ETF, exchange-traded funds, which I'm write about in Big Core Service. So it's a variety of instruments: binaries, ETFs, spread bets, with the ETFs being longer term. Well, I do try with binaries are shorter term positions. As I say, I'm moving away from those to an extent, but I still suddenly use tunnel bets. Because I enjoy. I think it's a nice, relaxed way of trading, really. Mark, any points?
I mean, as I said, it's all down to market conditions as well, because we'll be talking about this in a minute with the trade setups. But if you've got a very volatile market, then I have a personal preference to use binaries because you're less likely to get stopped out. But if you're in a sort of a less volatile trending, or there's some very clear setups, then I'll use spread bets. And obviously in the morning as well, I get a lot of opportunities and a lot of systems that come out at 8 o'clock on the market open, and spread bets are better suited to that. So the type of instrument you use, it's not really what proportion, it's not a fixed proportion, it's about what fits into what trading style you're using and what trading style is best suited to that point in time in the market.
Okay, thank you. And the last question is a little bit, so why does the FTSE follow the Dow in the afternoon? I don't think it does follow the Dow. My own view is that there's a global trend and that all markets follow that trend. And in fact, what often happens is the Dow, the traders on the Dow, look at the other markets like FTSE when they open, and they will see what that's done, and then they will react accordingly. Similarly, FTSE traders will look at what's happened overnight in Japan. Japan will look at what happened overnight in Tokyo, and all these markets are coordinating to an extent, especially with the high-speed communication we've got now, and traders, trading different markets. I think there's much more coordination, and all these markets showing an aspect of the global trend. And you see most markets, especially FTSE, Dow, DAX, tend to do similar things. The Nikkei is slightly different because it sort of, peaked in 1989. So its bear market has now been 22 years in the making. Quite a considerable period of time. And it's often said that the average from a peak, a major peak, it takes at least 25 years to get back to that major peak, and Nikkei is a good example of that. So, how much longer it's going to take, I just don't know, because I think there's a case for Western markets seeing a major peak quite soon, and I can't see the Nikkei totally ignoring sharp falls if we do see that.
Okay, the next stage we're going to look at a trade setup and an insight into what I'm looking at in the markets and what basically makes me take a trade, and also how to trade in a market crash. So I'm going to use an actual trade that I did for the service, and if we look at my screen, you should see that I issued a report on the 15th of March, and we're going to go behind the scenes of this particular trade that I recommended for the service. So first things first is let's look at the charts. So we can see that we're actually in a bull cycle at the moment. And the bull cycle was instigated, for those who don't know, on the technical side, it was instigated from an inverted head and shoulders pattern which broke out at 5,477. So this is when the technicals on the charts turned bullish. And we can see that on this particular chart, we can see that there was a nice rise from December, and we had a bit of a correction in January, and then we made some we made a double top in February. But when we declined in January, we actually found support at 5,860. At that point, that wasn't that relevant, but it did become relevant, quite a few weeks later. So we had the decline in January. We move up, and we made a double top at just above 6,100. Now, this is termed as minus development, and minus development is basically when the market hits a certain level and it fails to develop beyond that. So we can quite clearly see on this chart, this is the daily chart of the FTSE, that the market was unable to get through 6,100. So that is your first bear signal, okay? That's tick number one. We then move down, and we can see on the charts, we move down to this support line, and we can see that we tested it 1, 2, 3, 4 times. Okay, so at that point in time, that is triggering alarm bells for me. We're not making any action beyond that, and it also corresponds with the level of support that we had in January. So at this point in time, I'm making a clear note of that if markets make an end-of-day close below this level, we're going to get a decline. The reason I use end-of-day close is that is when it avoids price spikes, and for me, if the market is closing above or under a level, then it has accepted that price. The market has said, yep, we accept the market will trade above or below that level. Okay, so moving on, we then bounce up from this level of support. We have that noted, and then we move back down again, and lo and behold, we have an end-of-day close below 5,860. So at this point, I know we're going to have a decline of some sorts, but I don't think we're going to have too much of a decline because we're still in this bull cycle, and we're still in a bull cycle until I see an end-of-day close below 5,477. So for me, any decline, no matter what it's linked to, Japan or nuclear bombs or whatever, I'm not going to get bearish until I've seen the market close below 5,477. So another interesting point that I was looking at is that during bull markets, if a market corrects, it usually likes to test its moving average 200. Okay, so at this point in time, the moving average was located at 5,600. So I'm seeing that if we have a correction, 5,600 for me is a good opportunity to buy the FTSE. Okay, so we'll now go back to the actual report and the day I was issuing this. So that's what I was looking at to begin with. So I'm expecting the decline, and I'm looking at buying opportunities. So the decline starts on the 15th of March. Overnight, the market had tested the moving average 200, but it actually bounced. So in the morning, on the morning of the 15th, we were trading near 5,700, and I was looking at the market retesting this, because sometimes the market likes to retest important areas if it's done it out of hours. So the report was look for buying opportunities. You know, this is a good opportunity to buy the market, and somewhere between 5,600 and 5,477 would be the area to get in. Now the next point is, what do I trade the market with? Okay, we're in a serious decline. The market's crashing. Do I want to use a spread bet? Well, the answer is no, because during a market crash, we talked about volatility, and the chances of a stop being hit are very high. So instead of looking at that, I was looking at binaries. Another key point is that the market also had given me two system signals. Okay, so one was at 5,920 and one was at 5,740. Now, for those of you who are part of my subscription list or have come to my seminars, will know that I combine analysis with systems. So I will not trade one without the other. So I have to have both analysis and I have to have my systems both telling me to enter a trade. So in this instance, my analysis is saying buy opportunity, and I had two system signals at 5,740 and 5,920. When I issued this report, I was actually looking at 5,920 because I didn't think I was going to get a good price for 5,740. However, what actually happened was the market opened, lo and behold, we crashed right down to the moving average 200. At this point in time, I issue an alert to my subscribers to buy the market, and the instrument was it was on bet on markets, and it was for the FTSE to touch 5,740 within 12 days time. So a nice, quite a nice period of time for it to achieve this at a price of 30, which means that for every £30 I was investing, I would get a return of 100. So the risk reward was pretty good for that particular trade setup. I will also sort of mention that when I'm doing these reports, I do give the riskier option as well, because not all my subscribers like to use binaries. So I also said that for higher risk traders, any decline down to 5,600 is a buy, and your stops should be at an end of day close below 5,477. So it turned out to be quite a good buying opportunity, and I don't know, there might be some subscribers who are still holding that trade if they went long with a spread bet. So what happened after this event? So we're long. The market did bounce at 5,600, but a couple of days, I think it was 2 days after, the market actually went down, and this was after hours. The FTSE closed, and I think there was another problem in Japan. There was some nuclear problems, and the FTSE just plummeted. Within a couple of hours, it went right down to 5,500. Now, this is a key point. We know that we're in a bull market as long as we're above 5,477, and there's not many amateur traders who would have known about that key level. They would have been focusing on this chart that I'm showing you here. This is the weekly chart, and it shows you two clear parallel lines and a clear channel with support at 500. So what actually happened was, out of hours, the market plunged down, and it just went past 500. So I would have imagined that would have clipped a lot of people who were long in the market, and they would have come out not realizing that the key point is 5,477. But for me, for the service, we're not worried about that, because A, we're in a binary, and we don't need to worry about these spikes of volatility. So that was irrelevant because it happened overnight, and by the next morning the market was actually in positive territory anyway. So again, with the binaries, you can sleep at night. You don't need to worry about losing too much in the market and these wild swings that happen out of hours. And as we know what happened after that. We've just pretty much risen in a straight line. So that was the trade setup. That's sort of an insight in what I'm looking at when I'm looking at these sort of longer term trades. And hopefully you found that helpful. Okay, John, on to the next topic.
Let me say on risk tolerance. This is actually quite a short little thing about risk tolerance. It's a key aspect of trading psychology because it affects the amount of money you can make from trading. I mean, a lot of people come along and they think, right, well, I want to replace my salary by trading, and maybe you're getting 50 grand a year or something. I mean, the first problem with that is that you don't often get traders making more than, say, 25%. I mean, it does happen. You get people who start with £1,000 and they manage to build up to £1 million. But it's not like winning the lottery. You've got to have a ton of luck to do that. And luck's against you, then you just won't do it. You'll lose your £1,000. And also you'll take huge risks. But it's something that we're not actually trained to do. We're not sort of, our experiences in life are generally not to do that kind of thing. We don't want to put everything down on red on the left or something, because we might well lose all the money. It doesn't happen very often. When it does happen, it's a big news item, like the guy who sold everything he once had. I don't remember his name. I think it was in my book, actually, one of the books I wrote. And he sold his house, all his clothes. I think he just had one outfit left. He put everything on black and roulette, and there was a big news story, and he actually won. Otherwise, he would have had nothing at all. Because people don't do that kind of thing. It's not the way we're trained what to do. But if you find that you have great difficulty going at, say £10 a point, for example, then clearly the amount of money you can make from trading is going to be very limited, in the sense that you may well make 10,000 a year, but that's not going to replace a £50,000 salary. So the point I'm making is that, I mean, there are things you can do about it. I don't tend to present a situation and say, well, this can be a problem, without presenting some kind of solution to it. And one solution is you can see a trading coach, and you can talk it through with people who, neuro-linguistic programming is all about reprogramming the mind, so you can do things you couldn't do before, for example. So that's one aspect. Another is simply to build up, to start trading in smaller quantities, make money, get the confidence from the success you've had, and then build up to larger and larger sums. But the point is, it's just something to think about, really. It's something that is, as with lots of things in trading, I think it's quite an important point you need to be aware of. Is that really all I'd say on that particular point? So I'll now go back to the questions that we're getting. Johnny, moving in and away from the microphone. Well, I can't be. It's actually attached to me, Ken. So I'm hoping that's.
I was about to say, John, you're actually you're coming across quite weak at the moment. The voice is not flowing very well.
Oh, I mean, that could be a system problem rather than, because I mean, I'm talking into a microphone which is a fixed distance from my.
That's better now. It's fine now.
Okay.
But before it will.
But it was audible.
Just.
Okay. Okay. Okay now. Thank you, Leo. Okay, that's the end of those questions, so that's good. So we can go on to the next point. We've done that, haven't we? Mark, was there another session you had to do today, or not? There wasn't, also. So we could go through to the questions we had from the last session that we were left over with. Yeah. Okay.
Let's move on.
Okay. Basically, these were questions that we dealt with that arrived for webinar 3, and we ran out of time. We try and stick to about an hour, 10 hour, 20. We're doing an hour 10 now, so I think 10 more minutes will probably suffice. So, and of course, well, I am recording. Thanks for reminding me. Okay, Mark, well, the first one's yours. Best ways to scalp the markets, please.
Yeah. I would just add that I wasn't getting any questions through from the last piece I was talking about on the insight into what I'm looking at for a trade setup. So if there are any questions on that, please punch them through now, and I'll deal with that after these questions here.
I've got a question.
I've
got a question here, Mark. If you would like to, linking Mark and John's comments on the FTSE, Are you still both the opinion that we are in a bull market above 5477 with a target around 6,600? If so, is there a binary bet to consider, say a one-touch hit 6,500 in 2 or 3 months? Or can bets not run that long? Yes, they can with BOM. Is there a daily finance cost? No, there isn't, other than the loss, other than the deposit you've got to pay, so lots of interest on the deposit. But Mark, I think the main question is about the bull market. Are we in a bull market above 5, yes. Which is what you said. I think yes, that was.
Until we see the market close below 5477, then we're technically in a bull market and we will continue rising. However, that said, I mean, the markets are very toppy at the moment, and ideally we would prefer to get in on a correction, on the next correction. We've had the markets have shot up from 5,500, the last correction point, and that's not to say we can't go any further, but I would prefer to sort of get in on the next correction rather than get in at this point in time. For me, at the moment, the markets are quite wafy, and there's a case of a correction as per my analysis, but the timing is obviously we can't pinpoint that at the moment.
Okay, there's a question from Robin here. Mark, my query is that your tunnels on your charts look very neat when you do them, but it always looks very different when I'm trying to make sense of the ups and downs on the chart. I mean, that's because we trade on the right-hand side of the chart. We trade on a bit we can't see. So, unfortunately, when we illustrate the point, we're really forced to give you charts that you can see. Otherwise, it's not a regular illustration. But certainly, when you're in the heat of the market, all the emotions are bubbling away, and of course, you can't see what's coming next. So, I think that's probably why. Mark, you want to add to that?
Yeah, I mean, it's short term. So, as I said, I can only sort of issue what I can see on the chart at that point in time, and also it's very short term as well.
Okay, Mark. On last bit on trade setups, would it be an idea to hedge on binaries against a spread bet from your trade setup?
Yeah, I mean, you can do, definitely. I do it personally sometimes. If I'm in a good trade and I'm looking for a bit of a correction, then yes, go ahead. I mean, I would say test it. If you're not new to it, maybe trade it, see how you get on. But certainly, yeah, binaries can be very effective at hedging.
Okay. And I would just make one point. They're not a direct hedge, though, and there's a mismatch between a binary and a spread bet. So it's not always, or it does provide a hedge. It doesn't provide a hedge that is always a perfect. Well, it's never really a perfect match, but it can be.
It's not like for like.
Yeah, it can be useful. When you say short-term trading, what timescales are they?
Well, I mean, a lot of my trades are done daily, but as I said, I do give trade recommendations as per my emails for longer term trade setups as well. So ideally, if I'm entered on a trade and it's a very good area to get in, then I'll manage it as far as I can. I've got no problems with that at all. But as I said, in terms of subscriptions and my subscribers and what they receive, I give them a sort of a mixed bag. I give them a long-term view if they want to take that, and I give them the short-term view as well.
I would just add there is some flexibility in these terms. I mean, short-term, medium-term, long-term have different meanings to different traders, and really you need to define these in your own terms, really. But I mean, generally, if you look at a monthly chart, that's pretty long-term. Those industry with that. 5-minute chart is pretty short-term, and somewhere in the middle you've got the medium-term. But it is something that each, there is a variation in what each trader would give to those terms.
And also, I mean, when you're analyzing the market, there is no such thing as just short-term. You should be starting right from the top. So taking your weekly charts, taking your daily charts, taking your 1 hour, right down to 5 minutes. It's not ideal. You should be just looking at one chart. You need to look at the whole picture and then make a trading decision based on that. It might be a short-term trade, but you still need to be looking at the bigger picture, as I was showing you before.
Okay, a question from Dave. Can you say something about daily loss limits for the trader, e.g. 20-point loss and quit for the day? I mean, I would say, again, this is a personal thing, a personality thing, which you need to design for yourself. But yeah, I mean, it certainly makes sense. I mean, some traders do just say they throw in the pounds, that's it, I'm closing down for the day. and when they make money, they just keep going until they close, or whatever. So it's certainly something that can play a part in your trading armory. But again, it's something you either do or don't want to include. I mentioned the tale of Larry Levy, who some of you may have known or do know, who once was having trouble putting trades on. Some traders have trouble putting trades on, mental blocks, etc. So he bought these subliminal tapes, which he listened to while he was asleep, to help him with this. And the following day, he did 600 trades because he couldn't stop trading, and lost quite a lot of money as a result. So I mean, that's an example of something you don't want to do, I guess. It's not too relevant, but it's quite an amusing story, I think. Well, not for him, I guess. When you say short-term trading, what timescales? I've just done that one, so let me go on to the next one. Hang on, this is quite a long question. Hi, thanks for the comment on a 6,500 one-touch, but I'm confused why to wait for a correction, since I understand the benefit of binary longs, that it does not matter if there's an interim correction. No, it doesn't matter, but you get a better price, I think is the main point.
Yeah, I mean, a 6,100 one-touch now would be priced very, very high, so probably up in 70s or maybe even 80s. So then you're taking on 80 points of risk for 20 points reward, and that's not what we want to be doing in trading. The last one touch I did, we were taking on 30 points of risk to make 70 points of reward. So there's a key point there as well.
Right, Mark. The question we started here with, actually we've got 5 minutes left. So any more questions, please ask them now. Obviously, the last few we may not be able to answer because we have, really should close down after 1 hour 20. It's quite long enough for everybody concerned. Right, best ways to scout the markets, please, Mark.
Best ways to scout the markets. I mean, again, it depends on your instrument, but spread bets are usually the chosen choice, and you want to be using probably 1 minute down to the tick charts. The tick charts are the quickest and the quickest form of charts you're going to get, and scalping traders look for, it can just be a couple of points here and there, up to about 10 points. Very, very quick in and out trades. For me, it doesn't suit my personality. I don't want to be sat at the screen all day, nicking sort of trades here and there. But for some people, that's what they like, and they don't want to hold trades for more than 5 minutes. Some people, and it works for them. But certainly, if you want to look at scalping, then look at very short-term charts. As I said, 1 minute down to tick charts, and probably the best instrument you want to be using is a spread bet. And you want to be choosing a provider which gives you a spread of no more than one pip. Anything more than you're going to be paying too much in spread to be, to open and close these positions over and over again.
Okay, what do you think about what's happening in the Arab world and how it will affect this year of trading? I mean, obviously, what's happening is very fundamental for the Arab world and probably for the world at large in certain ways, but it doesn't affect the market much, which is just fixated on this quantitative easing, and where else to put the money, which, with interest rates remaining low, stocks are better because bonds aren't giving a huge return, although of course some are because of the risk of default, but that's of course a risk, so that's something you've got to bear in mind. So I think as interest rates start to rise, and of course we just see a small increase in the ECB rate this week, that could be one of the fundamental turning points that are going to come, because the QE is fueling inflation. Governments want inflation because it knocks down all the liabilities, which are like the sword of Damocles hanging over the entire economy, whole world economy really. So they can devalue their currencies and therefore devalue all this debt. Then that's the basic game plan. So it's all they've got really, but it's not boosting the economy, and that's where I think things are going to have to go south, because I just cannot see how people can just keep on going indefinitely. It's been going on for a long, long time now, to an extent. But currently, what's happening in our world is being largely ignored by the markets. I mean, not totally, but we're seeing the Dow at new highs. So I think it's not having much effect. I mean, obviously the whole thing blew up into a much bigger conflict, which doesn't seem likely right now. Then that would be something else, but we don't know whether that'll happen or not. Right, question for me. Do you envisage a strong FTSE pullback into a major sport in the near future? Well, I'm thinking it should happen. I mean, it certainly looks due, but we just haven't seen it. I mean, we haven't really seen these very subnormal declines, really, which don't complete a sort of normal pattern. And that's what's making it so difficult right now. I think we'll do 2 more questions. Let's get to the next page. Do you trade with a strict system or just, I think it's discretion rather than discrete? I could highlight these questions because I might make it a bit late in the day, late in the day to do so. Bit of both, really. I mean, I use POM on a regular basis. That's a system, but I may well use a bit of discretion as well. I use PDS from time to time. I use tunnel trading from time to time. And Mark, your comment on this?
I mean, I follow POM as my daily sort of system personally, and then for the service, I'm looking at a collection of systems, and I link that with systems as well. So for my actual trading edge, I'm looking at combining systems and analysis, and for me that works quite well.
Okay, well, I think there's one more question. It's now 11:20. Hi guys, what are your entry triggers for swing trading? Thanks in advance. And Mark, any comments on that?
Well, I mean, I've just talked you through a swing trade. That trade we looked at before. Yeah, if I would recommend, if you're going to do any sort of research and really look into your trading, focus on price action, because you'll notice that in the illustration I went through before, I didn't use any indicators really. So I'm really looking at price action to determine my swing entries, and as I said, the trade before was sort of a perfect illustration of what I'm looking at.
Okay, well, I think that's the end of our webinar today. I hope you found it interesting and useful. Thank you for all those who've been participating and for your questions. And we'll be holding another one in a few weeks' time. And Mark, any final points?
No, thank you all for listening. And again, yes, it will be. We'll be tuned up next month for the fifth webinar. So
yes.
join you then. Hopefully with no technical problems this time as well.
Yes, indeed.
Okay,
thank you again.
Bye.